Welcome. What is an option trading? What are known strategies for making money in an option trade? In finance, an option is a contract which gives the buyer the right, but not the obligation, to buy or sell an underlying asset or instrument at a specified strike price prior to or on a specified date, depending on the form of the option. The strike price may be set by reference to the spot price of the underlying security or commodity on the day an option is taken out. Or it may be fixed at a discount or at a premium. The seller has the corresponding obligation to fulfill the transaction to sell or buy if the buyer exercises the option. An option that conveys to the owner the right to buy at a specific price is referred to as a call. An option that conveys the right of the owner to sell at a specific price is referred to as a put. Both are commonly traded, but the call option is more frequently discussed. The seller may grant an option to a buyer as part of another transaction, such as a share issue or as part of an employee incentive scheme. Otherwise, a buyer would pay a premium to the seller for the option. A call option would normally be exercised only when the strike price is below the market value of the underlying asset, while a put option would normally be exercised only when the strike price is above the market value. When an option is exercised, the cost to the buyer of the asset acquired is the strike price plus the premium, if any. When the option expiration date passes without the option being exercised, the option expires and the buyer would forfeit the premium to the seller. In any case, the premium is income to the seller, and normally a capital loss to the buyer. The owner of an option may on-sell the option to a third party in a secondary market, in either an over-the-counter transaction or on an options exchange, depending on the option. The market price of an American-style option normally closely follows that of the underlying stock, being the difference between the market price of the stock and the strike price of the option. The actual market price of the option may vary depending on a number of factors, such as a significant option holder may need to sell the option as the expiry date is approaching and does not have the financial resources to exercise the option. Or a buyer in the market is trying to amass a large option holding. The ownership of an option does not generally entitle the holder to any rights associated with the underlying asset, such as voting rights or any income from the underlying asset, such as a dividend. Option strategies. Option strategies are the simultaneous, and often mixed, buying or selling of one or more options that differ in one or more of the option's variables. Call options, simply known as calls, give the buyer a right to buy a particular stock at that option's strike price. Conversely, put options, simply known as puts, give the buyer the right to sell a particular stock at the option's strike price. This is often done to gain exposure to a specific type of opportunity or risk while eliminating other risks as part of a trading strategy. A very straightforward strategy might simply be the buying or selling of a single option. However, option strategies often refer to a combination of simultaneous buying and/or selling of options. Options strategies allow traders to profit from movements in the underlying assets based on market sentiment. In the case of neutral strategies, they can be further classified into those that are bullish on volatility, measured by the lowercase Greek letter sigma, and those that are bearish on volatility. Traders can also profit off time decay, measured by the uppercase Greek letter theta, when the stock market has low volatility. The option positions used can be long and/or short positions in calls and puts. Bullish strategies. Bullish options strategies are employed when the options trader expects the underlying stock price to move upwards. They can also use theta with a bullish/bearish combo called a calendar spread, when sideways movement is expected. The trader may also forecast how high the stock price may go and the time frame in which the rally may occur in order to select the optimum trading strategy for buying a bullish option. The most bullish of options trading strategies, used by most options traders, is simply buying a call option. The market is always moving. It's up to the trader to figure what strategy fits the markets for that time period. Moderately bullish options traders usually set a target price for the bull run and utilize bull spreads to reduce cost or eliminate risk altogether. There is limited risk trading options by using the appropriate strategy. While maximum profit is capped for some of these strategies, they usually cost less to employ for a given nominal amount of exposure. There are options that have unlimited potential to the up or downside with limited risk if done correctly. The bull call spread and the bull put spread are common examples of moderately bullish strategies. Mildly bullish trading strategies are options that make money as long as the underlying asset price does not decrease to the strike price by the option's expiration date. These strategies may provide downside protection as well. Writing out of the money covered calls is a good example of such a strategy. The purchaser of the covered call is paying a premium for the option to purchase, at the strike price, the assets you have already own. This is how traders hedge a stock that they own when it has gone against them for a period of time. Bearish strategies. Bearish options strategies are employed when the options trader expects the underlying stock price to move downwards. It is necessary to assess how low the stock price can go and the time frame in which the decline will happen in order to select the optimum trading strategy. Selling a bearish option is also another type of strategy that gives the trader a credit. This does require a margin account. The most bearish of options trading strategies is the simple put buying or selling strategy utilized by most options traders. The market can make steep downward moves. Moderately bearish options traders usually set a target price for the expected decline and utilize bear spreads to reduce cost. This strategy has limited profit potential, but significantly reduces risk when done correctly. The bear call spread and the bear put spread are common examples of moderately bearish strategies. Mildly bearish trading strategies are options strategies that make money as long as the underlying asset does not rise to the strike price by the option's expiration date. However, you can add more options to the current position and move to a more advanced position that relies on time decay, theta. These strategies may provide a small upside protection as well. In general, bearish strategies yield profit with less risk of loss. Neutral or non-directional strategies. Neutral strategies in options trading are employed when the options trader does not know whether the underlying asset's price will rise or fall. Also known as non-directional strategies, they are so named because the potential to profit does not depend on whether the underlying price will increase or decrease. Rather, the correct neutral strategy to employ depends on the expected volatility of the underlying stock price. Examples of neutral strategies are Guts, buy or sell a pair of IDM, put and call. Butterfly, a neutral option strategy, combining bull and bear spreads. Long butterfly spreads use 4 option contracts with the same expiration, but 3 different strike prices to create a range of prices the strategy can profit from. Straddle, an options strategy in which the investor holds a position in both a call and put with the same strike price and expiration date. Paying both premiums. Strangle, where you buy a put below the stock and a call above the stock, with profit if the stock moves outside of either strike price. Risk reversal simulates the motion of an underlying, so sometimes these are referred as synthetic long or synthetic short positions depending on which position you are shorting. Caller, buy the underlying and then simultaneous buying of a put option below current price and selling a call option above the current price. Fence, buy the underlying then simultaneous buying of options either side of the price to limit the range of possible returns. Iron butterfly. Sell two overlapping credit vertical spreads, but one of the verticals is on the call side and one is on the put side. Iron condor. The simultaneous buying of a put spread and a call spread with the same expiration and 4 different strikes. An iron condor can be thought of as selling a strangle instead of buying, and also limiting your risk on both the call side and put side by building a bull put vertical spread and a bear call vertical spread. Jade lizard. A bull vertical spread created using call options, with the addition of a put option sold at a strike price lower than the strike prices of the call spread in the same expiration cycle. Calendar spread. The purchase of an option in 1 month and the simultaneous sale of an option at the same strike price in an earlier month. For a debit. Bullish on volatility. Neutral trading strategies that are bullish on volatility profit when the underlying stock price experiences big moves upwards or downwards. They include the long straddle, long strangle, long condor, long butterfly, and long calendar. Bearish on volatility. Neutral trading strategies that are bearish on volatility profit when the underlying stock price experiences little or no movement. Such strategies include the short straddle, short strangle, ratio spreads, short condor, short butterfly, and short calendar. What is an option trading? What are known strategies for making money in an option trade? Thank you for watching this video. Goodbye.